What would your comment be on the period pre-Lehman? Do you think the Indian banking system was appropriately regulated, over-regulated, under-regulated?
I do believe that we were exceedingly well regulated, and not enough credit has been given to proactive actions that were taken by the regulator. Let me give you a few illustrations. When you have excesses which lead to financial crisis, these are based on overlending, overborrowing, and imbalances that are created in the economy. I think Dr. Reddy recognized that. So he focused on real estate, increased the risk weight, increased the provisioning norms, stopped banks from lending on land. So the entire real estate bubble, if any, would bypass the banks. It's bypassed the whole system. He did the same for the stock market. He put capital exposure norms. He limited the total exposure, and so you had no bubble in the stock market. When retail lending was going too high and was also aiding in inflation, he increased the risk weight and he increased the provisioning norms. When people were not pricing assets right, he tightened money, and this, coupled with all norms, forced the participants in the market who were not pricing it right and would have run into a problem to revise their pricing. So in terms of a regulator acting proactively to look at systemic risks, I think we did a damn good job.
All right. Considering that we have escaped the turmoil itself, would you say, therefore, we continue in this regimen? You seem to be saying that no. Now is this time to take the first step towards getting more marketized?
Absolutely. Let me put it differently. I think what has happened is we've got a chance to leapfrog and come out with the right system without going through the miseries of our Western brethren.
Yes.
So our banking system is fine, alive and kicking, and doing reasonably well. We do not have a corporate debt market. We definitely need a corporate debt market. We've been talking for a long time about a corporate debt market. The issue in my mind is, if you need a corporate debt market, you first need a highly efficient and liquid sovereign bond market. We have a sovereign bond market, but the liquidity is only in 10 years. Because of that, you cannot have an arbitrage-free Indian rupee yield curve. So we probably need to issue a lot more securities across multiple tenors to have the yield curve. Once we have the yield curve, we need, and so that we don't throw the baby with the bathwater, we need basic interest rate derivatives in terms of futures and options. We're starting with 10 years, that's where the liquidity is. I hope it comes down. But most importantly, we don't have a spot market. There are not enough investors. So we can keep talking, and that's why probably our debt market is not developing, that unless we liberalize the insurance, the provident fund, the pension funds, etc., for large-scale investors to come into the debt market, which creates a spot market, the futures market will come later. Now, we don't want a 401k out here where everybody feels he's completely lost, but there can be an intermediate step where maybe with bank-guaranteed corporate debt, these guys are allowed to invest in the interim, and in the long run, they can invest directly. But the issue is the spot market. And without a bond market, I can tell you, we can't finance infrastructure.
Well, at the moment, there are about 4 or 5 or maybe a dozen people at best who are interested in this market, who are maybe the investment bankers who probably hold it to maturity. Under such circumstances, a repoability of these bonds, will it make really any difference? Or do you think we might as well just wait for the pension funds to arrive?
It will make some difference, but if you're saying, creating a repo market, making bonds eligible for repo, some difference in the liquidity. But it can't take away from the fact that you don't have enough investors. So the first, in my view, is the investors. And I don't disagree with the Reserve Bank that the risk should ultimately go to these investors. But my point is, we've been trying for a long time to get it going. And if temporarily the risk is taken by the banking system, to just smooth it, because these are government organizations, it's much more difficult for them to make a decision and then be held accountable. If we can smooth it, in my view, the most important thing is to have the spot investors.
Yeah, it would perhaps be a catalyst.
Yeah.
Now, coming back to the Lehman impact, what we actually saw in the Indian marketplace is a rush of money and a kind of a market preference, in some places at least, to the public sector banks. I mean, I can rattle out numbers. The deposit growth with public sector banks in September 2008 was 25%, was 21%. It shot up to 24% by March 2009. At the same time, the deposit growth for private sector banks, which was at 14% in September, fell to 8.9% in March. Similar figures even for lending. You clearly saw the center of gravity shift towards public sector banks. How do you look at this new regimen? Is this posing a different kind of competition?
Okay, I've got to be careful on this one, so let me do it as diplomatically as I can. I don't agree with the fact that the gravity shifted to the public sector banks. Because, statistics is something that you can drown in 4 feet of water.
Okay.
You would realize, without going into the names, that the largest participant in the private sector banks has said that they are restructuring and not growing. If you take them out of the equation, the private sector banks grew at the same rate, almost, as the public sector banks. So that is a statistical aberration. But within that, I must say, as far as even the flight to safety is concerned, if you take the Reserve Bank statistics, money moved to State Bank and money moved to HDFC Bank, which I am very proud of.
Okay.
So I don't think the gravity has shifted. If you're saying have the public sector banks become a little more aggressive, I would think yes, on the asset side.
That's exactly what I was coming to. And I don't have to mince words or be diplomatic. We are seeing a huge kind of aggression coming from State Bank of India. Is that altering margins or altering the grammar of competition?
Well, it's altering margins maybe for him or not. I don't know. I think to some extent. But as far as we are concerned, no, it is not altering our margins. We have not felt the need to go in for that pricing. When you look at that pricing for the section that he's pricing for, in large cases we've been able to retain the business. So the answer to your question is, has State Bank become very aggressive? Yes. Would they be gaining market share? Yes. Are we losing market share? No. Is somebody losing? Yes. And is somebody losing margin? I would guess so. I don't know.
Okay. Well, let me put it this way. Look at another impact of the Lehman and what happened thereafter. The contraction in credit. For the industry as a whole, the credit growth, which was up at 30% in early 2000, fell to about 25% by the time we came to December, despite the fact that Indian banking system was replacing foreign credit. But from December onwards, up until today, up until August, it's fallen drastically to 14%. How are you looking at this? Do you think that we will come out of this trough? Month after month, we are hoping we will come out, but we are still going a little and little lower. Do you think we will even make it to 20% for a FY09 average?
I think around the 20% seems very feasible. We are clearly seeing a recovery in the demand, especially if you see it on a sequential basis. If you compare it to the boom period last year, you don't see much of a growth. But every quarter, we are seeing the growth. We saw 5% in the first quarter, we're seeing thereabouts. So we, for ourselves, definitely see around 20%. We also see that the growth is linked to the GDP growth rate. So if you think there's going to be an average growth rate of about 6% across the year, then you will see between 18 and 20% growth rate for the system.
Well, what about the cost of money? Do you think that whatever fall that there was to be in interest rates is over and done with? Or do you think rates may still fall a little before they pick up?
I do not believe that there is any more scope for interest rates to fall. Interest rates have fallen substantially. I also believe because of the excess liquidity in the market, some of the top-rated corporates are getting unrealistic rates. We also have a situation, so I do believe that rates will not go down. Regarding the rates going up, I think that cannot come unless there is regulatory action. And regulatory action I don't think will come till there is growth or unless he's concerned with inflation.
Well, so what would your expectation be on policy rates?
See, what I'm saying is, I think the most important part is first to see what level of growth we get.
Okay.
I do believe that whether it's the central bank or the government, the first priority is the growth. Okay. And they would even be willing to live with some amount of inflation tolerance unless they see good growth. Okay. And the last thing they would want to do would be to stall growth prematurely. So that's what I'm saying. Interest rates will not go down. Will they go up in a hurry? No. At some point of time, is the bias upwards? Yes. Unless the central bank does it, the liquidity is very high.
Okay.
Today, deposits are growing at 20%, and assets are growing at 14%. You have reverse repo of 140,000 crores. Overnight, you're not going to have an avalanche of demand. So, unless there is very, very severe regulatory action, I don't see too much movement in interest rates.
Okay, let me come to another industry issue, not terribly linked to Lehman, but then, yes, has been the fallout. NPAs. A part of it, of course, got restructured. But do you think we are out of the NPA issue? Do you think the worst is over? Or do you think we're going to see a couple of quarters of bad loans, or even more quarters?
I think as far as the retail NPAs are concerned, the worst is over. Mm-hmm. Because if you take the worst around the October, November, December area, if in 180 days he hasn't paid you and you haven't recognized it as bad, there's something wrong in your systems. Okay. So I think as far as the retail NPAs, they will be the normal NPAs, but I think the spike is over. As far as the corporate is concerned, I think there also the worst is over, but that comes with a lag. So for 1 or 2 more quarters, you won't see a further spike, but you may see similar as what was happening. More importantly, if people have restructured smartly, then they would have done what is deep restructuring. Okay. So it will be very short-sighted to restructure and then go through the same problem 6 months later. So hopefully they've taken a moratorium of a year at least.
What's your estimate, therefore, that NPAs will remain for the industry at the same level, or can it get a little worse?
Largely, give or take, very minor amounts. I think we're there.